committee met this week, deliberated and assessed global and domestic macroeconomic developments and the balance of risks to the outlook. The summary of the assessments and key considerations that informed the committee's decision on the positioning of the monetary policy rate is as follows. Global growth continued at a steady pace in the second quarter of 2024, supported by stronger spending, a resilient services sector, and declining crude oil prices. However, continued weakness in the manufacturing sector, moderated growth momentum in China, cooling labor markets in advanced economies, escalating geopolitical tensions, and rising uncertainties related to elections in many countries could potentially weigh on growth prospects in the second half of 2024. The latest projections by the International Monetary Fund forecast growth to remain unchanged at 3.2% for 2024 and slightly up to 3.3% in 2025. Global inflation continues to slow down on account of declining crude oil prices, food prices, and moderating wage growth. Crude oil prices fell due to weaker than expected economic growth in China. The Food and Agriculture Organization's Global Food Price Index declined by 1.1% in August on the back of lower prices for cereals, meat, and sugar. In addition, cooling labor markets in advanced economies have contributed to moderation in wage growth, which has helped reduce services inflation. Core inflation has also declined in both advanced and emerging market economies, with the weakening US dollar playing a crucial role in alleviating inflationary pressures for emerging market and developing economies. Looking ahead, the ongoing global disinflation is expected to continue, albeit at a slower pace. Central banks in major advanced economies have begun the much-anticipated policy easing cycle amid declining inflation rates. The Federal Reserve Bank, the European Central Bank, and the Bank of England have all reduced their policy rates in recent months as inflation gradually approaches targets. The expectation for lower policy rates has brought down long-term bond yields, supported a rebound in equity prices, and led to a strengthening of portfolio flows to emerging market and developing economies in recent months, as investors search for higher yields. Further declines in the policy rate in advanced economies is expected to result in an easing in global financial conditions in the near term. Provisional GDP data from the Ghana Statistical Service for the second quarter of 2024 point to a stronger growth outturn than expected. Real GDP grew by 6.9% in the second quarter of 2024, compared with 2.5% in the corresponding quarter of 2023 and 4.7% in the first quarter of 2024. Non-oil GDP growth was 7%, compared with 3.1% in the same period of 2023. The growth outturn was largely driven by a strong performance in the industry sector, which grew by 9.3%, having contracted by 2.6% same time last year. The services and agricultural sectors also grew by 5.8% and 5.4%, respectively. Trends in the bank's high-frequency real sector indicators point to sustained pickup in economic activity. The updated Real Composite Index of Economic Activity recorded an annual growth of 1.6% in July 2024 compared to a contraction of 2.8% for the corresponding period of 2023. Construction activities consumption demand by households and firms, exports, imports, and tourist arrivals contributed to the improvement in economic activity during the period. The latest surveys conducted in August 2024 show a rebound in both consumer and business confidence. Consumer confidence improved on account of easing inflationary pressures, which has led to optimism about future economic conditions. Similarly, business confidence firmed up as firms met their short-term targets and expressed positive sentiments about company and industry prospects amidst improving macroeconomic conditions. The survey findings were broadly in line with observed trends in Ghana's Purchasing Managers Index, which improved to 51.1 in August 2024 from 50.1 in the previous month. Domestic price development since the last MPC indicate a disinflation process that remains on track. This was largely supported by the still tight monetary policy stance and easing food inflation. Headline inflation has declined consistently since the last MPC to 20.4% in August from 22.8% in June and 20.9% in July 2024, driven mainly by food inflation. Food inflation declined to 19.1% in August from 24% in June and 21.5% in July, while non-food inflation dropped marginally to 21.5% from 21.6% in June 2024. The bank's main core measure of inflation, which isolates prices of energy and utility items from the consumer basket, eased to 19.4% in August 2024 from 22.1% in June. Provisional data on budget execution from January to July 2024 indicated an overall fiscal deficit on commitment basis of 2.4% of GDP against the budget target of 2.8% of GDP. The deficit of 24.8 billion Ghana cedis was fined from domestic 24.2 billion and foreign 17.4 billion cedis respectively. The primary balance for the period was a deficit of 3.8 billion Ghana cedis or 0.4% of GDP against a primary deficit target of 3.5 billion Ghana cedis or 0.3% of GDP. Developments in August 2024 showed a decline in total liquidity relative to the corresponding period in 2023. Annual growth in M2 Plus declined to 37.1% in August 2024 relative to 40.8% in August 2023 due to a moderation in the pace of growth in net domestic assets of depository institutions. In contrast, net foreign assets of depository institutions increased significantly, reflecting a net build-up in foreign assets. The decline in broad money supply was reflected in a slower pace of growth in demand deposits, savings and time deposits, and foreign currency deposits. Growth in currency held by the public, however, increased over the same comparative period. Private sector credit continued to grow during the review period to 21.7% in August 2024 from 10.7% in August 2023. In real terms, private sector credit recorded a growth of 1.1% relative to a 21% contraction in 2023. On a year-on-year basis, money market interest rates broadly trended downwards. The 91-day and 182-day Treasury bill rates declined from 24.8% and 26.7% respectively in August, from 26.35% and 27.84% in the corresponding period of 2023. Similarly, the rate on the 364-day instrument declined to 27.9% in August 2024 from 30.8% in August 2023. The weighted average lending rate on the interbank market increased. The rate increased to 26.84% in August 2024 from 26.59% in August 2023. The average lending rates of banks to households and firms over the period declined marginally to 30.7% in August 2024 from 31.78% in August 2023. The banking sector's performance continued to improve, with assets growing at 38.7% at end August 2024 compared to 19.6% in August 2023. Both pre-tax and after-tax profits were higher in the first 8 months of 2024 relative to the same period last year. On solvency, the capital adequacy ratio of the industry stood at 10.3% in August 2024, higher than the 7.5% recorded in August 2023. With reliefs, the capital adequacy ratio was 13.8% in August 2024 compared to 14.2% in August 2023. Liquidity and efficiency ratios also improved during the first 8 months of the year, highlighting that broadly key financial soundness indicators are improving in the banking sector and remaining positive. Despite these improvements, the NPL ratio was 24.3% in August 2024, up from 20% in August 2023, reflecting increased defaults from large borrowers and highlighting that elevated credit risk remains the primary concern for the sector's outlook. On the international commodities market, trends in the prices of Ghana's major export commodities were mixed. From the beginning of the year to August 2024, crude oil prices declined by 2.1% to settle at an average price of $78.9 per barrel due to slowing demand in China and the US. Cocoa prices eased to $7,409.5 per ton in August, after climbing to an all-time high of $10,116.8 per ton in April 2024. In contrast, gold prices rose by 21.3% on a year-to-date basis to an average price of $2,469.39 per fine ounce on the back of geopolitical tensions and expectations of rate cuts by the US Federal Reserve. The external payment position was strong in the first 8 months. The trade balance recorded a provisional surplus of $2.78 billion, higher than the surplus of $1.66 billion recorded in the corresponding period of 2023. The surplus was primarily driven by an increase in gold and crude oil exports. Total exports went up by 22.3% to $12.92 billion. Notably, gold exports rose by 62.2% to $7.27 billion, while crude oil exports went up by 16.7% to $2.7 billion. In contrast, cocoa exports, both beans and products, fell by 42.7% to $917.8 million in August 2024, mainly due to the challenges posed by extreme weather conditions. The total import bill increased by 14% to $10.14 billion over the same period. Of the total, oil imports increased by 3.6% to $3 billion, while non-oil imports went up by 19% to $7.1 billion. The strong build-up in international reserves continued into August 2024. Gross international reserves increased by $1.58 billion US dollars to $7.5 billion US dollars at the end of August 2024, equivalent to 3.4 months of import cover. Net international reserves also increased by 1.73 billion US dollars to 4.92 billion US dollars at the end of August 2024. The higher buildup in gross international reserves was largely on account of the strong performance of the domestic gold purchase program. After coming under pressure in May and June, the exchange rate has generally stabilized in recent times. This was mainly driven by the still tight monetary policy stance and improved forex liquidity support. From the beginning of the year to 25th September 2024, the Ghana cedi depreciated by 24.3% against the US dollar. In the second half of the year, the cedi has witnessed a slower pace of depreciation of 7.1%. Summary and outlook. The external environment has improved since the last MPC meeting, as global economic activity remained resilient in the second quarter of 2024. Growth was supported by private and government spending, a resilient services sector, and declining oil prices. Additionally, the anticipated policy easing cycle initiated by major central banks in advanced economies in response to declining inflation rates have also been supportive of growth. These conditions are favorable for the domestic economy. The domestic economy continues to recover, evidenced by the stronger than expected GDP outturn for the second quarter of the year. Growth in the second half of the year is also expected to be firm, supported by sustained activities in the construction sector, consumption of goods and services by households and firms, exports of gold and crude oil production, as well as banks' extension of credit to the private sector. The external payment position continues to improve, characterized by higher trade surplus and strong reserves buildup. Notably, the robust growth in gold exports has helped to improve the trade balance and international reserves, complemented by external financial inflows from the IMF and the World Bank. These together have contributed to an improved balance of payments position in the first half of 2024. Looking ahead to the end of the year, the balance of payments is projected to achieve a surplus, driven by increased exports, stronger remittance flows, and lower government external payments. In the assessment of the committee, preliminary data since the last MPC meeting held in July 2024 indicates that macroeconomic conditions have generally improved. Headline inflation has eased and growth has picked up. Fiscal policy implementation has been robust, providing impulse that is supportive of growth, while monetary conditions have remained tight and supportive of the disinflation process. Headline inflation since the first quarter has declined for the fifth consecutive month by 5.4 percentage points. Core inflation has also declined sharply over the same comparative period by 6.9 percentage points. These trends suggest that the disinflation process is on course. The latest forecast showed that the inflation will continue to ease towards the range target of 13 to 17% for the year and steadily track back towards the medium-term target of 6 to 10% by the end of 2025, bearing unanticipated shocks. At the current juncture, the committee judged the rates to inflation outlook as fairly balanced. Given these considerations, the committee decided to lower the monetary policy rate by 200 basis points to 27%.